Today I'll talk about how we help clients choose the best whole life insurance product when they're considering Guardian as the insurance company of choice. We'll focus on two of their more popular products, which are called their whole life L95 product, specifically with their 5% paid up additions rider fee, and then their 10-pay product, which has a 10% PUA fee by default. And to clarify, if you have any experience with Guardian or Guardian agencies, we're looking at their pure 10-pay product, not what is called their 10-pay flex product, which does offer a 5% PUA fee option. Now, we are going to look at max funding whole life insurance policies, which means the priority is getting as much cash value as possible. So whenever we're doing this, the goal should always be minimize the base premium as much as the insurance company will allow, add a term insurance rider to prevent a MEC, a modified endowment contract, which is a taxable event, and then maximize the paid up additions rider. What we're going to look at with respect to the funding is in the first year, we'll look at a lump sum. It'll be a total deposit of $100,000 up front, and then the second through the 10th year will be $50,000 per year. Now, when we look at Guardian as a company, and these two steps, minimize premium, maximize PUA rider, Guardian is a company that does offer a lot of PUA flexibility. Remember, premium dollars do not show up in cash value, typically in the first year. You'll see that with the L95 product, whereas PUA dollars do show up in cash value in the first year. So I want to minimize the piece that does not show up in cash value and maximize the piece that does show up in cash value. Now, Guardian as a company will allow you to commit only to the base premium, that plus the term rider, and then add additional money into your PUA rider at your discretion. So what that means is I can have a policy where I have close to a $5,000 minimum premium. I can put in a total of $100,000 in the first year, but I'm not required to do that. Meaning everything above that minimum can just be added at my leisure by logging onto my online account, my mobile app. It could be a wire transfer. There's no limit to the number of times I can add money to my PUA rider. I can just dump in extra cash toward my paid up additions rider, which helps accelerate the cash value growth. So people that want to commit to the minimum and add more discretion, a lot of times will gravitate toward Guardian because they offer that flexibility, and they're one of the 4 major mutual companies, meaning we've seen proof of performance from them. So when we look at the L95 product, specifically with the 5% PUA fee, let's go over their PUA rules. If we add a term insurance rider, specifically referred to as a 1-year term or OYT rider, here's the rules. In the first year, we can go up to 50x the base premium. So a lot of times when someone has a large lump sum of money, they do like Guardian because of that rule. We can add a lot of extra money in the first year. And from the second year onward, I can add up to 10x the base premium as long as I still have a term insurance rider attached. Now, eventually that is going to burn out, or I could remove it. You'll see exactly what I mean when we look at some of the illustrations. Now, that same product without a 1-year term rider, which means I start a policy without it, I remove it, or it eventually burns out, here's what the rules would look like. The first year, I could still go up to 50x the base premium. From the second to the 10th year, I can only pay 3x the base premium in PUAs. And from the 11th year onward, I can only pay 1x the base premium in PUAs. An important side note here is Guardian's illustration software will allow agents to still illustrate 3x the base premium without a 1-year term rider beginning the 11th year if it's a scheduled PUA. However, they won't actually allow that. That's important to be aware of. If we want to add money that's more than 1x the base premium to a Guardian policy, we would need a 1-year term rider. Meaning if you want to continue to add beyond the 10th year, call it 3x, they may require medical underwriting is the big thing to be aware of. That's exactly what you'll see in their contract language and from our experience, what we've seen. But just a quick side note there that's beneficial to be aware of. That's their L95. Here's their 10-pay product. 10-pay, default, 10% PUA fee with a 1-year term rider. First year, 50x the base premium. Second year onward, 5x the base premium. The 10-pay product is the one product that doesn't allow us as an agent to illustrate 10 times the base premium. It's only 5 times, which means the policyholder is going to be forced to a higher minimum base premium. So you'll see some of the pros and cons as we look at the comparison. So with a 1-year term rider, I can illustrate up to 5x the base premium. Without a 1-year term rider, 2nd through 10th year, it's 3x. The first year is 50x no matter what. That's what I can illustrate. And from the 11th year onward, it's 1x the base premium. Now, a 10-pay product has premiums only for 10 years. However, Guardian is a company that from the 11th year onward will still accept PUA payments to that product, meaning you can not have a base premium and still shovel money into PUAs, which is pretty cool. However, we do want to look at the MEC situation as cool as that sounds, it's not always possible. All right, let's take a look at the comparison. What we're going to look at specifically are both the non-guaranteed and guaranteed values. So we'll start with the L95 product. Here we go. What you'll see here, first year, you'll see $100,000 going in. And if we look at the left, we can see our guaranteed cash value. Total outlay, first year, $100K, and then $50K per year through the 10th year. Up here is your base premium, $4,500 and change. Where we came up with that number is Guardian, as a company, will allow us to illustrate 10x the base premium in PUAs. And then the first year, remember we could go up to 50x, so that's where this extra PUA is coming in. We're actually showing a max of close to 20x, so we could go higher, but we just made it 20x for this example. Now, the STP, what that stands for next to PUAs is, over the years, I've worked with Guardian for a long time. My name's Steve. If you haven't met me before, nice to meet you. My wife's name is Tara, and our last name's Parisi. So because of all of the business we've brought Guardian over the years, they dedicated this paid up additions rider to my wife and myself. So they called it paid up additions rider Steve and Tara Parisi, which I thought was pretty cool. I'm totally kidding. That's not why. It stands for short-term performance because you see more cash value up front, which is another version of their 5% PUA fee. They also offer a 10% PUA fee. All right. So you've got the guaranteed values here. And then you've got the non-guaranteed current, which is based on their current dividend interest rate for 2025 of 6.10%. Okay, we're gonna look at a side-by-side comparison of this on Excel. What I just wanna highlight really, really quickly is the 1-year term rider. Let's take a look here. Here we go. This is based on the non-guaranteed values. What I wanna highlight here is this, that 1-year term rider. As we're pumping money into the policy, your whole life death benefit is going up and that term rider is going down. The whole life plus the term always equate to the net death benefit. You don't need to know all of the details. It's just important in order to be able to max fund a policy at 10x the base premium. If you don't have this attached, the big takeaway is you can only fund up to 3x the base premium. So if you want to be able to carry a lower minimum premium and maximize your PUA rider, this will allow you to do it. And if we do max fund the policy for a couple of years, you'll see the most cash value on a guaranteed and non-guaranteed basis as well, every single time. All right, so that's the L95 policy. Let's take a look at the 10-pay policy. What do you notice here? Same cash flow going in, higher base premium, $8,600. Why it's higher is because the most we can illustrate is 5x the base premium. Now I had to go up a little bit. If we truly minimized it, it would come out to $8,333.33. But I had to increase it to $8,600 just in order to get the death benefit at 1.325, which prevents a MEC from occurring more than anything else. It let us get the full 100K into the policy in the first year. But with all of that said, the base premium, even if we could minimize it by another $300, is still higher than what we would have with the L95. That is because the 10-pay through Guardian's illustration software forces a higher base premium for the client. So it is beneficial to be aware of. When we start to compare the two, one of the things I always like to say to someone is, when you look at the 10-pay, you will see greater long-term performance potential based on how the product is structured. You'll see that in a moment. However, they do force us to a higher base premium. So if you like the idea of committing to just the absolute minimum and throwing more money into the policy at your discretion, the 10-pay doesn't quite give you that. But you do get something based on the non-guaranteed potential from a long-term performance standpoint. So one of the pros and cons to weigh out. The guarantees are definitely a drawback to the 10-pay. The 10-pay has a 2% guarantee, whereas the L95 has a 3% guarantee. Let's take a look at a side-by-side comparison. This will be a bit easier to follow. Here we go. So here we have a side-by-side comparison. On the left, we've got the L95 5%, and on the right, you've got your 10-pay product. As we compare the two, there's some things I want to highlight here. Let's start with what's actually highlighted. What do you notice? The L95 5% breaks even 1, 2, 3 years in. That's a very early break-even point. The true minimum, this includes the base premium plus the term. It's actually closer to $5,300 or $5,400, but I just rounded here. The true minimum is about $5K. So what this means, if this is you can literally set the policy up where you're billed for this, or $5,300 per year. That minimum could be paid yearly. It could also be broken up over 12 months. And then this could be added to the policy on an unscheduled basis. You are also not required to pay this. A lot of times people think that, hey, I have to fund the policy according to the illustration, correct? You do not. The premium is initially required. The PUA is optional. That optional piece, though, is what beefs up my cash value. And also, in a case like this, if this is you and you funded the policy with $100K in the first year, guess what? You could stop altogether after that and still see your cash value continue to grow. We've got some other videos that go through that. Just search lump sum on our channel and you'll see some examples. But this is the L95 product. Major advantage to it, upfront cash value. Commit to the true minimum. So I'm billed for an amount that does not feel burdensome at all. I can easily pay that, and then I can just dump money into the PUA rider at my discretion. And because of the lower PUA fee, guess what happens? I see that hit cash value right away. If I'm viewing it as an opportunity cost, whether it's for real estate, business, whatever it might be, I see it, I feel it. I don't feel the upfront hit as much as I do with other whole life insurance products, which is extremely beneficial there for a lot of people that are using this for opportunities. So a lot of times we see this product option being a very popular choice because of that. Whereas the 10-pay, on the other hand, when we look at the break-even point, you're very close to year 4, but it's really year 5 when you're cash positive. And why it takes longer is partly because of the higher minimum premium, but then also we have the higher PUA fee at 10%, which takes a bigger bite out of the PUA payment. So the drawback here is less cash value up front, a higher minimum commitment. That's the part that hurts. What's the advantage? Look at it long term. By the 10th year, they're just about even, meaning the 10-pay has caught up at that point in time. What about after that? How much of a difference is there really? Let's take a look, shall we? So everything in red is showing how much less you have in the 10-pay, and you'll notice it's less for the first 10 years. What about after that? It gets stronger. The same is true with the death benefit. We can just compare that long term. So one thing to note, this is based on the non-guaranteed values. If we look at the guaranteed values, you see a different story, where here you're in the red forever, meaning the L95 has more upfront and also more long-term. The simple reason for that is because you have a higher guaranteed rate with the L95 product and also a lower PUA fee. So higher guarantees, lower PUA fees, and a lower minimum premium. If you're more conservative by nature, that's going to be appealing in that respect. They both work though. Guardian is a company that we track the performance of all of our clients. I've got policies with them. I track it. I've seen them deliver very, very close, in many cases spot on with the non-guaranteed values on their illustrations. So I've seen that proof of performance. At the same time, anything can happen. That's why we like to show both the guaranteed and non-guaranteed values. The 10-pay product, when people are typically attracted to this option, is usually someone who's comfortable with the higher minimum. And frankly, I see this with people who have a lot of excess cash sitting in savings, and they view this as a safe alternative to position some of those funds. Example, there's a hedge fund officer who I like to talk about, I like to share the story. He has had about $5 million sitting in a money market. This was some of his safe money because of the yields on money markets at that time. He liked it, but then after what he was paying the taxes, he's like, why am I doing this? Anyway, he saw the different options. We looked at MassMutual, Guardian. He ultimately decided to get a 10-pay policy with each company, Mass and Guardian, based on how those products perform. He liked the 10-pay because of the long-term potential. But he's in a position where he's not planning on using it at all. It's really a buy and hold strategy. But that's someone who we typically see gravitate toward the 10-pay more, whereas someone who's actively using the money and wants that low commitment will gravitate toward the L95. What I want to close with is, what if you can't decide? Well, there's two options that I'll present at this moment, although there are more. Here's two popular options. Option number one, you can split it. You can get one L95 policy and one 10-pay policy. Very simple to do. Number two, there is a product that's a bit of a middle ground, which is the L95 10% PUA fee. So if we go back to the illustrations, here we go. You'll notice here in the PUA section, there's no STP. That means no 5%. It's the 10% PUA fee. So what this means is when we compare the two side by side, it looks similar to the 10-pay up front. And then when we compare it long-term to the L95 5%, you have more, like the 10-pay. It's not as much as the 10-pay, but it does allow you to commit to a lower minimum premium and still have a higher guaranteed interest rate. The guaranteed values won't be as high with this one as they are with the 5% PUA fee because they've got a lower fee and the guarantees assume no dividends, but it's a nice middle option that we often show. So these are a few products that we often show with Guardian that definitely are the most popular options. If we do a survey of the different products that are selected with folks, it's usually the L95, 5%, 10%, and 10-pay product. On rare occasion, we'll look at a survivorship policy, and sometimes we use their 15-pay. And this is assuming we're trying to maximize cash value and always studying the different options that are available. Those products are solid in terms of maximizing cash value, and they also allow us to keep our minimum premium at a minimum, providing flexibility. So with all of that said, I hope you enjoyed this video. I'd love to hear any thoughts, questions, comments in the comments section below. And as always, I hope this helps. Thanks so much.